February 18, 2026, 7 o'clock Singapore time. #Americas. U.S. markets are starting the day focused on the balance between growth and sticky services inflation, with traders parsing the latest Fed communication for how long restrictive rates may stay in place. Earnings season narratives are splitting. Companies with pricing power and AI-driven capex stories are holding up better than consumer discretionary names facing demand normalization. Credit conditions remain the quiet swing factor, as higher-for-longer policy continues to test smaller borrowers and commercial real estate refinancing. In Canada and Mexico, attention is on trade and supply chain investment decisions that depend on U.S. demand momentum and FX stability. Commodity-linked sectors are tracking moves in crude, refined products, and industrial metals as macro data and geopolitics compete for price leadership. Across the region, the near-term risk is a volatility spike from surprise data prints, while the opportunity is selective quality exposure in cash flow resilient businesses. #Europe. European equities are navigating a mixed macro picture, with investors watching whether disinflation is fast enough to open the door to rate cuts without reigniting price pressures. The ECB's tone and the latest wage and services indicators are key, particularly for banks and rate-sensitive cyclicals. Energy remains a central variable for the continent's competitiveness, as gas and power price expectations shape industrial margins and forward guidance. The UK backdrop is similarly defined by inflation persistence versus growth softness, making the path of policy and sterling a core market driver. In the euro area, exporters are also watching global demand signals and any renewed shipping constraints that could lift costs and stretch delivery times. The main theme today is positioning for a slower growth environment. Defensives and quality balance sheets continue to screen well, while highly leveraged stories look more fragile. #Middle East. Energy markets remain the anchor for the region's financial conditions, with oil policy, spare capacity assumptions, and demand expectations all feeding into budget outlooks. Gulf equity performance is tied to liquidity and IPO cadence as governments continue to fund diversification projects and infrastructure. Investors are also tracking shipping and insurance costs in nearby sea lanes, because disruptions can ripple into input prices and delivery schedules far beyond the region. For non-oil economies, the focus is on tourism, logistics, and technology investment as engines of growth, alongside efforts to broaden capital markets. Geopolitical headlines can still overwhelm fundamentals in the short run, but the medium-term story remains the scale of investment programs and the pace of private sector participation. Today's watchpoints are crude's reaction function and whether risk premia in freight and insurance are easing or rebuilding. #Asia Pacific. In Asia, markets are weighing China's policy support and confidence signals against property sector repair and the outlook for domestic consumption. Japan remains a currency yen rate story, with investors focused on how wage trends and inflation momentum translate into any further normalization in policy settings. Australia and New Zealand are watching local inflation prints and labor market resilience to judge whether policy can pivot or must stay restrictive. India's narrative continues to be structural growth and capex, but valuations and near-term earnings delivery are under the microscope. Across the region, supply chain strategy is still evolving, with firms balancing cost, resilience, and geopolitics when allocating new manufacturing capacity. The key risk is uneven growth across major economies, while the key opportunity is selectively backing companies levered to productivity gains and regional investment cycles.